The global silver market is facing something we haven't seen in decades, a structural deficit of over 160 million ounces, with industrial buyers scrambling to secure supply at any price. What's happening right now could reshape the entire precious metals landscape, and if you're not paying attention, you're already behind. Thursday, February 12th, New York time. Please share in the comments what day and date you're watching this from. I genuinely appreciate seeing how far this message reaches. Before we begin, a quick note. I'm currently working to reduce copycat channels that mirror this content. If you find value in what I'm building here, the best way to support this effort is simply by subscribing and leaving the name George Williams in the comments. It may seem small, but it truly makes a meaningful difference. Now let's talk about what's really happening in the silver market, because the numbers we're seeing are absolutely staggering. As of February 11th, silver is trading at $84.72 per ounce, up nearly 5% in a single day. But that number alone doesn't tell you the whole story. What matters is the context, and that context is a market that's been in deficit for 6 consecutive years. Think about that for a moment. 6 straight years where global demand has exceeded mine supply by somewhere between 160 to 200 million ounces annually. That's not a temporary imbalance, that's a structural crisis. When we talk about industrial panic buying, we're not using that term lightly. This isn't about speculators or day traders. We're talking about manufacturers, technology companies, and industrial users who absolutely need silver for their production lines. And they're facing a reality where supply simply cannot keep up with their requirements. These are businesses that have contracts to fulfill, products to manufacture, and deadlines to meet. When they can't source the silver they need, production stops, revenue stops, and that creates a panic that drives prices higher, regardless of what's happening in the broader financial markets. The solar industry alone is consuming over 25% of the entire annual global silver supply. Let that sink in. 1/4 of all the silver mined each year is going into solar panels. And here's what makes this truly explosive. Solar demand is expected to nearly double between 2020 and 2030. We're not even halfway through that timeline yet, and we're already seeing supply constraints. Each solar panel requires silver for its photovoltaic cells, because silver is the most conductive metal on Earth. There's no substitute that works as efficiently. As countries around the world accelerate their renewable energy transitions, as climate commitments get more aggressive, as energy independence becomes a national security priority, the demand for solar panels is only going in one direction. And that means the demand for silver is going in one direction too. But solar is just the beginning. Electric vehicle demand for silver jumped 20% in 2025 alone. Every EV uses significantly more silver than a traditional combustion engine vehicle because of the electronic systems, the battery management systems, the charging infrastructure. As EV adoption accelerates globally, and all the major automakers have committed to going fully electric within the next decade, you're looking at exponential growth in silver demand from this sector. Then you add AI data centers into the mix. These massive facilities require enormous amounts of silver for their server systems, their cooling systems, their electrical infrastructure. The AI revolution that everyone's talking about, that's being powered by silver in ways most people don't even realize. What we're witnessing is a perfect storm of industrial demand hitting a market that's already been running deficits for 6 straight years. The mining sector cannot increase production fast enough to meet this demand. Silver mines don't just appear overnight. It takes years to explore, develop, and bring new mines into production. Most silver is actually produced as a byproduct of copper, lead, and zinc mining, which means silver production is largely dependent on the economics of those other metals. You can't just decide to mine more silver because the price is attractive. Now here's where things get really interesting. Physical investment in silver is forecast to rise by 20% in 2026 to reach 227 million ounces. That's a 3-year high. Think about what that means. You've got industrial users desperately trying to secure supply for their operations, and now you're adding massive investor demand on top of that. These investors see the same supply and demand fundamentals we're discussing, and they're positioning themselves accordingly. When you combine industrial panic buying with surging investment demand, all hitting a market that's already in its 6th consecutive deficit, the math becomes pretty simple. Prices have to go higher. The US government's decision to classify silver as a critical mineral in 2026 is absolutely significant, and most people are completely overlooking this. When the government designates something as a critical mineral, they're making an official acknowledgement that this material is essential to national security and economic prosperity, and that supply is at risk. This isn't just bureaucratic paperwork. This designation can lead to strategic stockpiling, trade restrictions, export controls, and a whole range of policy measures designed to secure domestic supply. If the US government is worried about silver supply, you should be too. Let's address the elephant in the room. On January 30th, 2026, silver experienced one of the most violent crashes in its history. The metal had reached a record high near $121 on January 29th. Within 30 hours, it had plunged to an intraday low just under $75. That's a 38% decline in barely more than a day. It was the most volatile session we've seen since August 2020. What triggered this? President Trump's nomination of Kevin Warsh as the next Federal Reserve Chair. Warsh is viewed as an inflation hawk, someone who would prioritize fighting inflation over supporting economic growth. Markets interpreted this as bearish for precious metals, and the selling began. But here's the critical part. The exchanges raised margin requirements right in the middle of this crash. When margin requirements go up, leveraged traders are forced to either add more capital to their positions or close them out entirely. Thousands of traders got liquidated simultaneously, which accelerated the crash and created a cascading effect. Even more mysterious was China's response. The Shenzhen Stock Exchange suspended trading in the UBS SDIC Silver Futures Fund for an entire day on January 30th. Why would they do that? What were they trying to prevent? The official explanation was about protecting investors from volatility, but suspending trading in the middle of a crash only creates more questions than answers. What is China doing with silver that they felt the need to shut down trading to prevent panic? These are the questions that keep market analysts up at night. Here's what you need to understand about that crash. It was brutal, it was violent, but most analysts view it as a necessary correction within a continuing bull market rather than the end of the rally. Silver had surged 54% in January alone before the crash. That kind of parabolic move is not sustainable. The market needed to reset. What's telling is how quickly silver has recovered. We're already back above $84, finding support around the $80 level. That's a strong sign that the fundamental demand is real and that buyers are willing to step in at these levels. So where does silver go from here? Let's look at the different scenarios because I want to give you a complete picture, not just hopium and unrealistic predictions. This is for educational purposes, and you need to understand the range of possibilities. The bullish case is compelling, and it's backed by serious analysts with real track records. Some forecasters see silver reaching $100 to $200 by early Q2 2026. JP Morgan Global Research, one of the most respected names in commodities analysis, is forecasting silver to average $81 per ounce for the full year 2026. Frank Holmes, a well-known precious metals analyst, sees silver reaching $100 this year. Alan Hibbard from Gold Silver expects silver to increase by over $100 per ounce to $175 or higher. These aren't random bloggers making wild predictions. These are analysts with decades of experience and research teams backing their forecasts. What would drive silver to these levels? The structural deficit we've been discussing is the foundation. You simply cannot run 160 to 200 million ounce annual deficits indefinitely without prices adjusting dramatically higher. Add to that the accelerating industrial demand from solar, EVs, and AI infrastructure. Layer on top the 20% surge in physical investment demand. Then consider the Federal Reserve policy backdrop. Markets are currently pricing in roughly 60 basis points of Fed easing by year-end. That's 3/4-point rate cuts or the equivalent. Lower interest rates reduce the opportunity cost of holding non-yielding assets like silver and tend to weaken the dollar, which makes dollar-denominated commodities more attractive. There's also significant safe haven demand rotating away from dollar-denominated assets amid policy uncertainties in Washington. The Warsh nomination, the questions about Fed independence, the geopolitical tensions globally, all of this creates an environment where investors seek alternatives to traditional currencies. Silver benefits from this dynamic just like gold does, but with the added advantage of industrial demand that gold doesn't have. The moderate case suggests prices in the $70 to $90 range, which is roughly where we are now. This scenario assumes stable demand trends, ongoing supply deficits, but no major breakout catalysts. JP Morgan's $81 average forecast fits into this category. In this scenario, silver continues to grind higher, but without the explosive moves we saw in January. Industrial buyers continue to secure supply at elevated prices, investment demand remains steady, and the market finds an equilibrium that satisfies both buyers and sellers. Under optimal conditions, we could see breakouts to $85 to $90, testing the upper end of this range. Now let's talk about the bearish scenario because you need to understand the risks. A strengthening US dollar is the biggest threat to silver prices. If the dollar rallies significantly, it puts downward pressure on all commodities, including silver. This could happen if economic data comes in much stronger than expected, if the Fed abandons its easing plans, or if there's a flight to safety that benefits the dollar specifically. In a bearish scenario, silver could drop to the $60 to $70 range. That would represent another significant correction from current levels. The other risk is if industrial demand disappoints. If we see a global recession that slows manufacturing, reduces EV production, or delays solar installations, that removes a key pillar of the bullish thesis. From a technical perspective, the market is watching several key levels closely. The $80 level has emerged as critical support following the January crash recovery. As long as silver holds above $80, the bulls remain in control. If we break below that level convincingly, it would signal that the correction might have further to go. On the upside, resistance sits at $85 to $90. A break above this range would likely trigger significant momentum buying and could open the door to testing triple digits relatively quickly. What makes this silver shortage different from past deficits is the combination of factors all hitting at once. We've had supply and demand imbalances before, but never with this level of structural industrial demand from multiple sectors simultaneously. The solar boom is unprecedented. The EV transition is happening faster than anyone expected even 5 years ago. The AI revolution is consuming resources at a pace that's hard to comprehend. And all of this is happening while mine supply struggles to keep pace and investment demand surges. The industrial versus investment demand dynamic is particularly fascinating. Historically, silver prices were driven primarily by investment demand and monetary considerations. Industrial demand was always there, but it was relatively stable and predictable. What's different now is that industrial demand has become the dominant force, and it's growing exponentially. These industrial users will pay whatever they need to pay to secure supply, because without silver, their operations shut down. That creates a price floor that didn't exist in previous cycles. Even if investment demand were to cool off, the industrial bid would still be there supporting prices. China's role in all of this cannot be overstated. The Shenzhen exchange suspension on January 30th was just one visible manifestation of what's likely much deeper strategic maneuvering. China is the world's largest manufacturer of solar panels. They're leading the EV revolution. They have massive infrastructure plans that require silver. If China is moving to secure silver supplies strategically, and all signs suggest they are, that removes even more supply from the global market. The suspension of trading might have been about preventing capital flight, or it might have been about hiding the true extent of Chinese demand. We may never know the full story, but what we do know is that when China moves in commodity markets, prices move. The timeline for how this plays out is the big question everyone wants answered. In the near term, meaning the next few weeks to months, we're likely to see continued volatility as the market digests the January crash and tests these new support and resistance levels. The $80 to $90 range is probably where we trade for the immediate future unless we get a major catalyst. By Q2 2026, if the bullish scenario is correct, we could see silver making a run at triple digits. The combination of tightening physical supply, continued industrial demand growth, and potential Fed easing in the spring could provide the catalyst. By the second half of 2026, if the deficit persists and industrial panic buying intensifies, the more aggressive forecasts of $150 to $175 start to look achievable. But here's what you really need to understand. This isn't about trying to time the perfect entry or exit. The structural story is so compelling that positioning yourself for this trend is more important than catching the exact bottom or top. The deficit is real. The industrial demand is real. The supply constraints are real. Whether silver peaks at $100, $150, or $200 this year is almost beside the point. The direction is clear even if the magnitude and timing remain uncertain. What we're witnessing is a fundamental shift in the silver market from a primarily monetary metal to a critical industrial commodity that happens to also have monetary properties. That combination is incredibly powerful and incredibly rare. When you find an asset with genuine industrial demand growth, structural supply deficits, and safe haven appeal all at the same time, you pay attention. I want to hear from you in the comments. Are you positioned in silver right now? Are you buying this dip or waiting for lower levels? What's your price target for 2026? And most importantly, drop the name George Williams in the comments to help support this channel against copycats. If you found value in this analysis, subscribe and hit that notification bell, because the silver story is far from over. We're going to be tracking every major development, every price move, every fundamental shift as this plays out. The 160 million ounce shortage isn't going away. Industrial panic buying is just getting started, and the next few months could determine whether silver becomes the investment story of the decade. Stay informed, stay ahead, and I'll see you in the next one.